Welcome back to the Live Off Rents podcast by Spark Rental. As always, I'm your host, Brian Davis. I am on a journey to reach financial independence, and I am not on this journey alone. Every month, our co-investing club gets together. We vet different passive real estate investments together. We put our own money in these deals, but relatively small amounts. I put my own money in these deals as my strategy for investing in real estate. And the other thing that we do every month, we get together a second time to bring in outside experts to come and speak to us and educate us about various topics relevant to passive real estate investing. And we also get to bring a lot of these experts onto the podcast to come and speak to people. So today we've brought in Erik Oliver. He's the vice president of the Cost Segregation Authority. And we wanted to ask him about how bonus depreciation works, because that's been a huge area of confusion for a lot of real estate investors over the last 7 years or so. And there's also been a lot of confusion about whether it's going to sunset or not. So, Erik, what can you tell us about how bonus depreciation works and whether it's sticking around or going away?
Yeah, no, that's a great question, Brian. So bonus depreciation has been around for a number of years. The government uses bonus depreciation to stimulate the economy. So if the economy is not doing well, they'll increase the bonus percentage. If the economy is doing well, they may decrease the bonus percentage. And so if we rewind it back to the 2017, the end of 2017, Donald Trump was our president. Donald Trump owns real estate. Donald Trump revised the tax code with the Tax Cuts and Jobs Act. And in doing so was very favorable to real estate investors. And so a couple things changed. Bonus depreciation at the time was at 50%, and it could only be applied to assets that had a useful life of 20 years or less, which usually excludes real estate, because remember, real estate gets depreciated over 27 and a half or 39. And more importantly, it had to be brand new equipment or brand new real estate. So a couple things changed with the Tax Cuts and Jobs Act. One is they increased it from 50% to 100%. So any assets placed into service between 9/27 of 17 and 12/31 of 2022 are eligible for 100% bonus. Everything in 23 that you purchased was eligible for 80%. In 2024, it drops to 60, and it slowly phases out until 2027 when it's down to zero. Now, in saying that, that's the current tax law. There is a bill in front of Congress. It actually passed the House almost unanimously. It did get caught up in the Senate. There was a few senators who didn't want to pass that bill in an election year, and so they kind of stalled it. The good news is that everybody in Washington owns real estate, and it's got bipartisan support, and it'll probably pass after this presidential election. So I'm hoping that early next year in 2024, there'll be a comprehensive tax bill that does include the extension of 100% bonus. But currently it's at 60%, which is still great. So that was one change. Let me go back to the Tax Cuts and Jobs Act. That was the first change. The second change was more important and more impactful, and that was they added 5 words to the tax code that made all the difference. So if you remember, bonus used to only apply to brand new assets. Now the tax code reads new to you, the taxpayer. So now I can go buy an existing apartment building or an existing residential rental. It was built in 1970. It doesn't matter. It's new to me, the investor. And all of a sudden I can apply bonus. And so again, bonus depreciation works well with cost segregation because cost segregation takes that 27 and a half year asset and it breaks it up into 5, 7, and 15-year chunks. Well, those 5, 7, and 15-year components are all eligible for bonus. And what bonus does is it allows you to take, for example, in 2023, when bonus was at 80%, it allows you to take 80% of your 5-year assets or the value of those 5-year assets and depreciate 80% of it in year one. The other 20% would spread out over the useful life of that asset. So what we're doing, cost segregation was around long before bonus. We were front loading and putting things into 5, 7, and 15-year buckets, which is still way better than depreciating them over 27 and a half years. But now we can put stuff in 5, 7, and 15-year buckets, and then we get to take 80% of all that stuff in year one. And so again, I always tell people bonus depreciation is like steroids for cost segregation because we're just putting it on steroids. We're taking even a bigger chunk in those early years. So the good news for us investors out there is that bonus depreciation will be around for at least through 2027. But my guess is that they're going to extend the 100% bonus at the end of the presidential election going into next year, back to 100%, but we'll just kind of have to wait and see. But like I said, bonus depreciation at any percent is good for investors because it just puts those cost segregation numbers on steroids and gives you an even bigger deduction in those early years.
Yeah, accelerate how quickly you can take that depreciation, take more of it right up front in the first year and the first couple of years. That's an interesting point about why and how it got stalled in the Senate, with a few senators not wanting it to pass in an election year, but there being broad bipartisan support in general to pass it.
Right.
So I hadn't heard that that line of argument before, that it will likely not get passed this year, but will likely get passed next year. That's an interesting prognostication. So, Erik, in 30 seconds or less, how do you help people, and how can people connect with you if they want to take you up on that help?
Yeah, definitely. So we love working with real estate investors to help reduce their tax liability. We're kind of a unique accounting firm where we don't do tax returns here, but we partner with your tax preparer to help you utilize some of these cost segregation strategies. And so we always do a free benefit analysis. If you've got properties you think might benefit from cost segregation, you can reach out to us on our website at www.costsegalauthority.com. And we'll get a little bit of information on your property. We'll run a quick benefit analysis to see if your property is a good candidate and if, in fact, we can save you significant tax dollars. And then if that's the case, then we'll work together. But we always want to make sure we run that analysis first to see that there's significant tax savings.
Awesome. Well, Erik, thank you so much for joining us today. And guys, if you enjoy these quick hit conversations that we have, please rate, review the podcast. Makes a world of difference to us. And on that note, we will catch you next time. Wondering how private equity real estate investing works? We get it. A lot of investors are put off by phrases like private equity or real estate syndication, but these completely passive investments are actually a lot easier than buying properties directly, buying properties yourself in your own name. So we offer a free 40-minute class called Hack the Rich, 7 Secrets We've Learned from Private Equity Real Estate. There's not even a sales pitch at the end. We'll show you how to invest in these on your own without any help from us. So go to sparkrental.com/hack to take the free class. And we can't wait to chat about your questions.